The origins of a bubble hunter. Who is Michael Burry? Michael Burry's name became globally recognized after the release of The Big Short, but his story begins long before Hollywood transformed him into the world's most famous contrarian investor. To truly understand why he saw the 2008 financial crisis coming, while nearly everyone else was blind, we must explore his unique background, his psychological edge, and the philosophy that turned him into one of the sharpest minds in modern finance. Burry was not the typical Wall Street figure. He didn't come from a wealthy family nor attend an elite business school with a golden investment career already laid out for him. Instead, Burry began his professional life as a doctor. He attended Vanderbilt University School of Medicine and later worked as a neurology resident. But while others slept after long shifts, he would stay up late analyzing stocks and writing detailed investment theses online. He had an obsession with value, paying attention not to hype or headlines, but to underlying fundamentals. This is where his journey as a visionary investor truly began. Burry suffered from aglasia, something that shaped both his personality and worldview. From childhood, he learned what it felt like to stand apart from the crowd, to be different, to be underestimated. This personal experience would later become one of his greatest advantages. He did not crave approval. He did not follow the herd. He did not seek acceptance. Instead, he trained himself to think independently, and in markets dominated by groupthink, that mindset became a superpower. While practicing medicine, Burry shared his investment ideas on early online message boards like Silicon Investor. His stock picks consistently outperformed the market, catching the attention of top hedge fund managers and financiers. His writing displayed a rare combination of deep fundamental analysis, risk awareness, and emotional detachment. Hedge fund legend Joel Greenblatt took notice and decided to back Burry with $1 million in seed capital to launch his own fund, Scion Capital. From the moment Burry entered the investment world full-time in 2000, he delivered astonishing results. Between 2000 and 2005, while the market struggled through the dot-com crash, Scion Capital generated returns exceeding 400%. How? By focusing on companies trading far below their intrinsic value, exactly when others were panicking. That was Burry's first major lesson for the world: when everyone is afraid, look closer. There might be treasure hidden beneath the fear. He earned a reputation as a deep researcher, someone who read not just the standard financial reports, but the fine print, the parts others ignored. He would dig into bond prospectuses, loan structures, and historical performance data with an intensity few could match. His autism diagnosis later in life helped explain this incredible hyperfocus. What others found boring, Burry found fascinating. What others overlooked, Burry analyzed for hours. This is how he discovered what would become his greatest investment of all time: the catastrophic weakness in the American mortgage market. In the mid-2000s, Burry became obsessed with the rapid growth of subprime mortgage lending. Banks were handing out loans to people who could not afford them. Mortgage-backed securities, MBS, once considered among the safest investments, had become ticking time bombs. The key insight Burry uncovered was shocking: a massive percentage of mortgages issued after 2004 would default as soon as their low teaser interest rates reset. While the financial world celebrated its unstoppable housing boom, Burry asked the uncomfortable questions: who is actually repaying these loans? What happens when rates rise? Why are banks assuming homeowners will never default? These questions did not bring applause, they brought resistance. Investors complained. Banks ignored him. Experts mocked him. Burry saw numbers. Others saw dreams. And when dreams rule the market, a bubble forms. Burry understood what bubbles represent: a collective delusion, a story people want so badly to believe that they ignore reality. Every major bubble in history, tulips, the dot-com boom, even crypto frenzies, follow the same psychological pattern. Hope becomes denial. Denial becomes greed. Greed becomes disaster. Burry knew the housing bubble was exactly this kind of story. So he prepared a strategy no one had ever attempted before: betting against mortgage-backed securities through credit default swaps (CDS). This meant paying small premiums every month, but ultimately earning enormous profit when the housing market collapsed and the banks were forced to pay out. It was a brilliant idea. And a terrifying one. Because betting against the most trusted market in America made Burry appear crazy, even dangerous. His own investors revolted. They demanded their money back. They called him reckless, irresponsible, and delusional. But Burry didn't care about being liked. He cared about being right. And the numbers were undeniable. This unwavering conviction was his defining trait. Michael Burry does not follow the crowd, he follows the truth. Yet, truth is often invisible until a crisis exposes it. As the housing market ballooned dangerously, the world celebrated rising home prices as the new normal. Meanwhile, Burry waited patiently, knowing that every day brought the inevitable collapse closer. Alone against the world, he played the role of a modern-day Cassandra, warning that disaster was coming while being ignored and mocked by the masses. That is the profound irony of Burry's genius. His greatest triumph began as his greatest burden. In Part 2, we will explore the dramatic escalation of his bet, how Wall Street tried to crush him, how panic gave way to fear, and how the financial system finally cracked under its own lies. Most importantly, we will uncover what Burry learned about power, greed, and the fragility of the global economy as he executed the most famous short position in history. Because Michael Burry didn't just predict a crisis, he changed how the world understands risk. The Big Short, fighting Wall Street, alone. As Michael Burry deepened his research into the U.S. housing market, the data became more alarming by the day. Adjustable-rate mortgages were resetting to unaffordable payment levels, loan standards were collapsing, and lenders were pushing high-risk products onto borrowers who neither understood nor could manage them. But the most astounding discovery Burry made was not about homebuyers, it was about the institutions enabling the entire system. Rating agencies were stamping toxic mortgage pools with AAA ratings, the gold standard for safety. Banks were packaging subprime loans into complex financial instruments while pretending they were low risk. Investors bought these securities blindly, trusting labels instead of logic. Burry saw a catastrophic mismatch, the illusion of security built on the reality of instability. And that is when he conceived his revolutionary strategy. If he could buy credit default swaps on these mortgage bundles, he could profit when they inevitably collapsed. The problem? There was no market for such swaps on subprime mortgages, because no one believed they could fail. Burry personally approached major banks like Goldman Sachs and Deutsche Bank with a counterintuitive request: sell me insurance on mortgage bonds you claim are the safest in the world. The bankers didn't fully understand his reasoning, but they were eager to take the other side. To them, Burry looked like the perfect customer, someone willing to pay premiums month after month on insurance that would never be used. They saw easy money. They saw a fool. They did not realize they were handing him the keys to billions. Once Burry initiated the trade, Scion Capital began paying massive premiums. Those payments didn't come from nowhere, they came out of investor accounts. And since the housing market was still booming, clients panicked. They demanded explanations. They demanded proof. They demanded their money back. Burry's answer remained the same: the numbers don't lie. But human psychology does. While the world obsessed over rising home values, Burry dug into loan servicing reports, noticing defaults already ticking up. Banks tried to delay the truth by changing the way they valued these securities. Even as foreclosures surged, they marked mortgage bonds at stable prices, an accounting illusion to hide the growing danger. Burry realized another profound truth about crises: the financial system protects profits before honesty. Though his trade should have already been profitable, the banks manipulated pricing to avoid acknowledging growing losses, because admitting weakness could trigger panic. Burry was stuck in the waiting game, a battle of patience versus deception. His investors saw only losses, they accused him of gambling and betrayal. But Burry saw a storm forming so massive that it would redefine modern finance. While under pressure, he made a difficult decision: he temporarily restricted investor withdrawals. This move, though legal and part of his contract, infuriated clients. Some threatened lawsuits. Others launched smear campaigns. Few believed in his logic. But Burry was not trying to be popular, he was trying to prevent his investors from abandoning the only strategy that would protect them from disaster. A key theme emerges here: courage in investing is rarely rewarded in the moment. Outsiders later praised Burry as a genius, but during the crucial years leading up to the crash, he was labeled arrogant, confused, even mentally unstable. That pain takes a toll. The late nights. The constant doubt. The weight of responsibility, knowing others trusted him with their life savings while simultaneously accusing him of ruining them. But Burry clung to facts like a shield. He kept studying the mortgage pools, examining terms like negative amortization and no-doc loans, where borrowers weren't even required to prove income. He saw adjustable rate resets coming like a tidal wave, millions of homeowners suddenly unable to pay. And finally, in 2007, the cracks turned into fractures. Payment delinquencies exploded. Home prices began to fall for the first time in decades. Mortgage defaults surged so violently that even manipulated valuations couldn't hide the truth anymore. The system broke. And Burry's position skyrocketed in value. Within months, Scion Capital earned over $700 million for investors, and personally netted Burry roughly $100 million. The very investors who previously mocked him now called him brilliant. But the victory felt hollow. Burry saw something dark behind the celebration. The triumph came not from innovation, but from a failure of ethics and accountability that destroyed millions of lives. He was right. But the country was broken. In 2008, banks collapsed, homes were lost, global markets plunged into chaos, and the world finally saw that Burry's warnings had been justified all along. Hollywood would later dramatize these events, turning his story into a symbol of prophetic finance, a lone man who saw the blind madness of the crowd. But behind the spotlight was a more personal truth: Burry had grown exhausted with the financial world. The attacks, the pressure, and the unwillingness of others to face reality left deep scars. And so, after the greatest trade of his career, he made a decision few would expect. He closed Scion Capital, returned outside money, and walked away from managing others. Because the lesson he learned was not about money. It was about how easily the world chooses ignorance over truth. In Part 3, we will examine what Michael Burry did after his legendary victory, the new dangers he warns about today, why he believes the next big crisis may already be forming, and how his worldview continues to challenge the foundations of modern investing. Because if there is one rule Burry never breaks, it is this: when everyone agrees, look deeper. Something is wrong. Michael Burry had run the numbers. He had spotted the weakness. He had constructed the financial weapons that would bring an entire system to its knees. But now, he stood almost entirely alone, not against Wall Street, but against his own investors. The year was 2007. Housing prices were still rising in the headlines, but below the surface, the first cracks were forming. Adjustable mortgage rates reset higher. Homeowners who had been granted loans they could never afford were beginning to miss payments. Burry was right, but the market refused to admit it. And in the financial world, being early is indistinguishable from being wrong. Investors wanted their money back. They demanded that Burry sell the credit default swaps he had taken positions in. They told him he was delusional, that his obsession with mortgage data was making him blind. They had forgotten one thing. Michael Burry never cared what other people thought. To protect his investors, ironically, from their own panic, he took the most controversial step of his career. He locked the fund, restricting withdrawals. Legal battles stirred like storm clouds. His investors called him a fraud, a reckless gambler, even mentally unstable. The man who had once been praised for seeing opportunity others missed was now accused of destroying wealth. Yet while the world mocked him, the data kept screaming the truth. The crumbling wall of denial. Inside Wall Street trading rooms, something terrifying began happening. Mortgage defaults, once a tiny ripple, exploded into a wave. Subprime lenders collapsed. For sale signs piled up like tombstones. The demand for housing evaporated overnight. And still, the securities tied to these failing mortgages somehow continued to rise in reported value. Banks weren't marking their portfolios to reality, they were marking them to fantasy. Burry watched, furious and fascinated. He had built financial fire alarms, yet the market had stuffed its ears. If these bonds were priced honestly, his positions would already show massive profits. But the banks, in an act of pure self-preservation, refused to update valuations. They needed one more illusion. One last breath before drowning. Then. It happened. A small cluster of mortgage bonds, the very type Burry bet against, was finally repriced. The bubble narrative shattered. Trading floors went silent. Panic replaced arrogance. And Michael Burry's portfolio erupted in value. The moment of vindication. Returns spiked, not by 10%, not even 50%. But by over 400%. His investors, the same ones who had ridiculed him, suddenly became silent. Phone calls that once carried threats and demands now arrived with forced politeness and congratulations. Burry's analysis, his spreadsheets, his insomnia, his relentless debt digging, was finally recognized as genius. The Big Short had paid out. But unlike Hollywood's triumphant music crescendos, real life doesn't grant joy so easily. After the fund achieved life-changing profits, Burry didn't celebrate. He didn't host interviews. He didn't attend award ceremonies. Instead, he closed his fund. He returned the profits. He walked away. Why? Because he had seen something the world still refused to acknowledge. The banks got bailed out. We got left with the bill. The victory felt hollow. Millions lost homes, jobs, retirement savings. Burry had predicted the explosion. But he never wanted to witness the casualties. The legacy of a reluctant visionary. Michael Burry's name would eventually become famous, thanks to a best-selling book and a blockbuster film. But fame was irrelevant to him. To this day, he maintains the same core belief that guided him through the chaos. Risk is greatest when it's least perceived. That lesson became the DNA of his investment philosophy. When everyone is euphoric, be suspicious. When data contradicts the narrative, trust the data. When risk hides behind complexity, dig deeper. Burry's strength was never being smarter than everyone else, though he was. His true power was the courage to stand apart. He didn't need validation. He needed the truth. After the storm, new warning signs. Years after the crisis, Burry remained watchful. His alarms continued. The explosion of government debt. The rise of passive investing herding money blindly. Assets valued by momentum, not fundamentals. Once again, people called him extreme. Overly cautious. Paranoid. But then, don't they always? Michael Burry believes bubbles form wherever prices detach from reality, whether in real estate, tech stocks, cryptocurrencies, or even index funds. And while markets celebrate each new boom, Burry keeps reading the footnotes, searching for the next overlooked source of risk. Because the truth about bubbles is cruel. The crowd never sees the danger until it's falling on them. The ultimate lesson of The Big Short. Burry's story is not just a financial tale, it's a study of conviction. A warning against the seduction of popular belief. And a reminder that courage in investing often looks like madness, until it becomes history. Here is the philosophy that turned a quiet doctor from San Jose into one of the most respected investors on earth. White heavy checkmark: do your own research, no matter how deep the rabbit hole. White heavy checkmark: ignore popularity, truth rarely wins popularity contests. White heavy checkmark: expect resistance, pioneers walk alone. White heavy checkmark. Prepare for chaos, even correct predictions come with pain. Michael Burry didn't predict the future. He simply read the present more honestly than everyone else. In a world addicted to optimism and illusions, that might be the deepest kind of genius. Final reflection. Imagine if Burry hadn't challenged the housing myth. Imagine if he had surrendered under pressure. Imagine if he had listened to the majority. The financial crisis might still have happened, but one of the most powerful warnings in economic history would have been silenced. In every market cycle, investors face a choice. Follow the crowd into comfort. Or confront the uncomfortable truth. Michael Burry chose the latter. And the world will never forget what he discovered.